So what if I told you that your mortgage might be backed by nothing but an inflated promise, and that lenders and developers have quietly shifted the risk onto you? Yet regulators are just watching, because the truth is dozens of Canadians are now holding loans for homes worth less than what they signed up for, and they may never see a bailout. It's overwhelming and it's frustrating, and if you're in the middle of it, you can feel like there's no good option. But later in this video, I'm breaking down the 3 smart moves you can make right now, whether you're a homeowner, an investor, or just thinking about buying in Canada. Hi there, I'm Claudia Ragona, one of the Ragona sisters, and today we're diving into why so many Canadian mortgages are really backed by nothing other than inflated home values and what that means for you. So stick around, because in the second half, I'm showing you exactly how to spot one of these traps and how to protect yourself. So don't forget to hit that subscribe button. So let's start with how we got here, because this mess didn't come out of nowhere. A recent analysis from Better Dwelling uncovered something huge. In Canada's pre-construction market, lenders have been using something called a blanket appraisal, and most people have no idea it's even happening. So what does a blanket appraisal actually mean? It's when a developer and a lender use the pre-construction contract price, not the real market value when the building is done, to determine how much they'll finance. So basically they're saying the home is worth what you agreed to pay, even if the market says it's worth a lot less. Now here, this is how it plays out. You buy a condo off a pre-construction plan, you make the deposit payments over the next few years. Then the unit finally completes, and now it's time to close. You go get a mortgage and the lender orders an appraisal. Normally, that appraisal would be based on recent sales or similar completed units. But with blanket appraisals, they slap the same value across multiple units based on the old contract price instead of what those condos are actually selling for today. So does that matter? Because when the market falls, guess who eats the loss? You do. The buyer, the small investor, the homeowner, and the regulator in Canada, the Office of the Superintendent of Financial Institution, also known as OSFI, has flagged this as risk. But it's treating it as a small affair. They estimate only about 1.4% of total mortgages are in newly completed condos from 2022 to 2024. This might seem like a small problem, but see, when you zoom in, you'll see the explosion waiting to happen right here in Toronto. This is ground zero. 45.4% of all condo completions in Canada over the past year happened right here. One city, nearly half the country's new supply. And it's not just about volume, it's who's buying. As of September, about 92,000 units are still under construction. And get this, roughly 70% of pre-construction buyers in Toronto are investors. People banking on these flips and appreciation or rental income that may never even come. So no, the risk isn't spread across Canada or even Ontario. It's concentrated in one city, one market, and thousands of buyers are walking straight into it blindly. Now imagine you're an investor or a home buyer who paid at the peak of the market, financed based on the contract price, and closed when the market values have dropped. Now you're stuck. You're owing more than what the property is really worth. That's cash flow negative landlord territory, or worse, default territory. So, all right, let's rewind and ask, why did it even get to this point? And why are lenders using blanket appraisals? Why are regulators okay with this? Well, first, developers needed to move units in the pre-construction pipeline. With record low interest rates earlier, speculators piled in expecting to flip units before completion. But when demand slowed and completion stalled, lenders adopted blanket appraisals to keep deals from collapsing. The Star even reported this explicitly. Major banks were backing loans based on purchase prices and not the actual market. So essentially, lenders use the method to maximize leverage and get deals done, shifting risk from the developer side onto the buyer side. And when home values were rising, this wasn't an obvious issue. Appreciation covered the gaps, but when values began to drop or stagnate, the problem became clear. A 20% price drop means your deposit from earlier is gone now, and you may owe more at closing. The regulator, OSFI, even acknowledged this mismatch in timing between the blanket appraisal and property values at the time the mortgage closes. But their numbers show the issue as material small, 1.4% of outstanding mortgages. That's a national viewpoint. But look at Toronto. 23% of mortgage dollars in Canada are tied to Toronto's market. When your biggest risk lives in a city with intense exposure and investor dominance, small national percentages don't exactly reassure you. Then we've got investor dynamics. Pre-construction investor buyers often never planned to hold the unit. They expected assignment profits. This is where you flip the condo before closing. But now they have to close and qualify for those mortgages, and often at higher rates with units that may rent at far less than their debt service demands. The article points out that 4 out of 5 investors who recently took possession knew they'd be losing money every month, but went ahead anyway to purchase it, hoping the property's value would go up later. And that's not investing, that's gambling with leverage. And when the market turns, you're left with the debt, the losses, and unfortunately, no easy way out. So here's the part that really stings. This isn't just some one-off mistake, it's a strategy. The article compares it to what happened in the US back in 2008. Big developers and lenders are shifting the risk onto the little guy, everyday investors and families who can't afford to take the hit. They make the profit, you carry the risk, and then things go south. You're the one left scrambling and not them. And here's the twist most people don't even know. In Canada, lenders don't just take back the home and walk away. They can use power of sale, which means they sell your property and still come after you for the difference. You lose the home and you still owe that debt. And that's not just foreclosure, that's financial whiplash. And here's what's really happening. Banks and developers are using inflated prices to approve these mortgages. Buyers end up closing at prices way above what the home is actually worth. And the risk gets passed down to you, not them. The regulators see it, but they're barely stepping in. And where's all this pressure building? Well, in places like Toronto, where tens of thousands of units are still under construction, and many with shaky financials from day one. And wait until you see what this actually means for homeowners in Toronto, because this isn't some distant theoretical risk. It's unfolding right now. People are closing on homes worth less than what they owe. So if you're a homeowner, an investor, or just thinking about getting into real estate in Canada, you need to be ready. So here are 3 things you need to know and do right now to protect yourself. You have to check your appraisal. If you're getting ready to close on a pre-construction unit, you need to find out how much it's being appraised. Was it based on real world sales or similar completed units? Or is the lender just using the original contract price from years ago? Ask directly. Was this a blanket appraisal? Was the value based on today's market? Or the price I agreed to pay way back when? Because if your unit is still being valued at 100% of that original contract, but real market comparables are now selling, let's say, for 40 to 60% less, and yes, that's exactly what's happening in Toronto, then you're already stepping into negative equity. Next, stress test your payments. Don't just assume your rent will cover the mortgage, and don't count on prices going back up anytime soon. So you need to ask yourself, if I hold this for 5 to 10 years, what happens if rates stay high and rents drop or resale values fall even more? You need to know if you can handle that hit, because if you're already losing money each month and crossing your fingers for appreciation to save you, I'm sorry, that's not a plan. This is the old speculative model, and it's unfortunately broken now. Then you have to have an exit plan. If you're holding a unit that's worth less than what you owe, you need a backup plan. Can you afford to hold on long term? Would you sell it at a loss? Would you restructure the financing or repurpose the unit? Whatever your path is, don't sit frozen and don't wait for the market to bounce back. And if you're just now thinking about buying, avoid the flip at closing mindset unless you're truly ready to hold through the years of negative cash flow and declining value. The condo market is extremely volatile right now, and we don't know for certain when it will fully recover. You need to look for more stable, less investor-heavy areas, not just shiny towers in overbuilt zones. And more importantly, stay on top of what's changing. Regulators like OSFI are already talking about tightening guidelines. Banks might get stricter with how they approve these loans. And don't forget, with power of sale in Canada, lenders can sell your property and still come after you for the rest. So watch hotspots like Toronto and Vancouver closely. That's where the risk is building up fast. So let's recap with the 3 takeaways. 1, a lot of Canadian mortgages right now are based on inflated values tied to pre-construction contracts and not what those homes are actually worth today. 2, the danger isn't spreading across the country. It's concentrated in high-risk investor markets like Toronto, where blanket appraisals are quietly shifting the risk onto buyers. 3, if you're buying, check your appraisal, stress test your payments, and make sure you have an exit strategy in place. Now, I want to hear from you guys. Who do you think should be held accountable for all of this mess? Is it the banks, the developers, the regulators? Drop your take in the comments. I seriously want to hear how you guys see it. And if this video helped make sense of what's really going on, please share it, like it, and hit that subscribe button because this stuff affects real people and more of us need to see it coming. Thanks for watching. See you in the next one.